We are here to pick up the conversation we started at last year's Marine Money around infrastructure funds and their growing relevance for the maritime industry. I'm joined today by 4 individuals who are actively involved in this thematic. Art Regan, CEO of Energos Infrastructure, Denny Sreckovic, partner at Global Infrastructure Partners, where he leads GIP Credit. Loli Wu, Managing Director and Co-Head of North American Industrials Investment Banking at Bank of America, and Daniel Sailors, Managing Director at Morgan Stanley Infrastructure Partners. Just to set the stage for the discussion, over the past decade, infrastructure-style investors have amassed an enormous pool of capital, which today stands at around $360 billion globally. That's an equity dry powder that's still looking to be deployed. The transportation sector broadly has historically been an area of focus for these investors, and we continually see them spending more time and deploying more capital into maritime-related areas, most recently with a number of the marine equipment leasing transactions who have seen investors like Brookfield, Stonepeak, Wrenhouse, or even the interesting investment that MSIP made into Pasha. And what would be great today is to focus on the contrast between what hasn't changed in the world of infrastructure style investing in the last year and what has changed in light of the shifting macroeconomic backdrop. And just to launch into questions, I might point to Art and then Loli for this first question, but we've seen infrastructure style capital become increasingly active in the marine sector the last decade. How have you seen this play out, both in terms of deal activity and also the impact these investors are having on the competitive landscape for operators?
Thanks, Brian. So when I think of infrastructure finance, I think it's been transformative. And thinking about timelines, I do go back 20 years, the advent of external capital in large volume into the maritime industry and what happened then. So early 2000s, we saw a lot of new capital come in from private equity, call it traditional private equity, and that was mostly in a growth strategy. We saw the public markets get a lot of new capital in, drove the IPO. I mean, the first 8 years of 2000 was like the IPO golden era, frankly, for shipping. The next block of capital that came in, let's say 2010 to 2015, that was also private equity, but more hedge fund. It was more distress-oriented. We even saw investors buying physical assets and doing new building orders in large volume, buying loan portfolios. Again, distress theme. Not exactly all that long-term thinking, shorter-term thinking. Some of those strategies didn't work out so well. The public markets got weaker from an investment standpoint. So I would say towards the end of 2018, 19, in that range, it was a tough time for the shipping industry as to where do you get the next block of capital. And then comes infrastructure funding. So when I always thought about infrastructure funding, it was about owning critical assets. And what did that mean? We think of hospitals and bridges and tunnels. Maybe some port equipment. Nobody thought about commodity shipping as necessary or critical infrastructure for the world. Thankfully, this group of people and many others funded a number of maritime investments, and I think it could very well be the next wave, where we're thinking about not only critical assets, but income. The strategies for infrastructure finance have been around long-term contracts, all very stable. And I think that it's what we've seen in the last several years, large volumes of deal flow where we're talking about big deals as well, transforming companies that needed a fresh look or a fresh partner. Most of it has been private, though. So I do think that there's the possibility that some of these platforms could eventually revive the public markets because finally we're hearing the world talk about shipping as critical infrastructure. So I think it's been a great run, and it's really just the beginning.
Loli, anything to add?
Yeah, I think I agree with everything Art said. It's been a real evolution over the last really 2 decades since infrastructure funds started investing in the marine supply chain. I think first of all in container ports, that was I think a pretty easy place for infrastructure funds to get comfortable with the risk profile. But what have we seen over the last 2 decades? It's just I think a widening of the lens, but still a lot of discipline from the infrastructure funds. And but you've seen capital obviously come into LNG and to other areas of contracted shipping. And Brian, as you noted, container leasing and other sectors of leasing. Just in the last year, right? You've seen Renhouse acquire a stake in C-Cube. You've seen Textainer be sold to Stonepeak. So I think there's more interest there, but at the same time, in the interest rate environment that we find ourselves in, I think cost of capital is also a little higher. So I think there's just a little bit more discipline out there. But I agree with Art, which is, again, I think infrastructure funds will be a good source of capital, for a certain set of assets and cash flows.
And it might just be helpful to lay out, what do we think about today when we say infrastructure assets? And I know the definition has evolved over time, and Art began talking about it, but I might point to Denny and to Daniel. When you think about infrastructure as an asset class today, what are the critical characteristics that make a business infrastructure-like and therefore investable? Maybe Denny, just to start with you.
Sure. Over the last couple of years, we've made investments in FPSOs, FSOs, FSRUs, LNG carriers, LNG bunker barges, Jones Act platform companies. So it's a very broad subsection of the maritime market, but really the characteristics that kind of flow through all those assets that we invested in are: 1, high barriers to entry; 2, very stable recurring cash flow, and that could be through contracts or an oligopoly position in the market where that particular company plays. 3, and it's particularly important in the last couple of years, inflation protection. So the ability to either explicitly pass through inflation to the customer or pricing power such that you can pass it through given where you stand in the market. And finally, I think it just really mitigated operational or construction risk. So really find a way to box in the risk on the cost side as well, which is very important for investors such as myself.
Thanks. I think that Denny and I are singing from the same hymn sheet a little bit. So I definitely agree with everything he had to say, right? I mean, so if we're trying to define it, it's everything he said: criticality, pricing power, et cetera, right? I think from a, from a cost of capital point of view, right, there's always some level of squishiness, but I would say several hundred basis points inside of a traditional private equity firm in terms of what we're looking to do. As a Confluence, we're attempting to very much reduce risk of kind of capital impairment, right? I think that if I was trying to add to it, we often have found playing where maritime meets the land is an interesting place, right? So, maybe we go into it in one of the subsequent questions, but I would say across our portfolio of transport assets, often there's kind of a port element to it as well, or there's something about the business that leads to a barrier, and that barrier is what allows for the pricing power. I'd also just say that at its core, we think about unit economics a lot, right? And so while, if I take myself back to 2012 when I was fortunate to help Bob Burke and the team start Ridgeberry, that was a play towards here's where we are in a cycle, and here's why this is interesting relative to where intrinsic value might be or where values might go through a cycle. It's not that there's not a willingness to make a call, but the underlying business model is a prerequisite that's probably different than how private equity might think about it.
And Daniel, I think you're heading exactly where we're planning to go next, but when you think about the marine sector, what are some of the segments within the industry that are already squarely infrastructure-like in their characteristics in your?
Yeah, sure thing, sure thing. So maybe I'll use our portfolio as an example, and Denny gave some other good examples, as did Loli, right? I mean, we own a ferry business in New Zealand. We own a Jones Act shipping business on the West Coast, between the West Coast and Hawaii. We own an FSRU business, and we own a stake in a Jones Act offshore wind kind of logistics and port business. And so, what do those things all have? They have something. Often it's a reasonably consolidated market. Generally, you have kind of long-term relationships with your customers, right? Maybe that's because of the barriers, and there's only a couple players, or maybe that's because they value service over price, right? Some of those things. But I'd say for us, we've found niches to be areas that we've ended up playing more, right? We're one of two ferry businesses that does all the transportation between the Cook Strait of the North and the South Island. In New Zealand, we are one of two players that does all of the transportation of kind of container goods between the West Coast of the U.S. and Hawaii, right? Our Hogue business, that's maybe a little more competition. That Hogue is one of the largest, but that is more kind of a function of there are still real technical barriers to be able to play there, and the revenue model is such that you've got long-term visibility. So those may be some of the things I'd hit.
Yeah, I'll just add to that. And clearly we have what is old in terms of what's been infrastructure for a long period of time, and that's ports, terminals, land-based infrastructure. Daniel mentioned passenger transport as well. That's been infrastructure for a long time, as well as LNG carriers, where you generally are able to get long-term contracts. Same goes for the offshore sector, whether it's FPSOs. What's new is, what you're seeing, and you saw some of this in the prior panel, is new supply chains are emerging that require a tremendous amount of investment. And in exchange for that investment, you're able to get typically long-term contracts, or it's a very captive market. A good example of this is production of low-carbon fuels. So you're seeing dual fuel ships. It's 50% of new ships on order globally are dual fuel. The infrastructure to produce, store, transport, and dispense LNG, methanol, ammonia, hydrogen doesn't exist. So we're seeing that investment start to happen today, and it's happening first with LNG. We're seeing it's happening with methanol, but that's going to be a tremendous amount of opportunity going forward. And similarly, I think Daniel mentioned this, decarbonization broadly, whether it's offshore wind or other trends, all of that requires a tremendous amount of land-based and maritime investment.
Denny, maybe just to stick with you and Daniel for one more question, but in a similar vein, for areas of maritime where we haven't yet seen infrastructure investors dive in, are there ways for operators to make themselves more relevant to this pool of capital?
The easiest way is to get a contract, but that's clearly not always an offer. For us, it's really how do you create a criticality around an asset? How do you create stability to the underlying cash flow stream? And for some sectors, you're never going to get there because the market is what it is. It's a merchant market, and prices tend to be volatile, but that's perfectly fine. But to make it infrastructure, getting a contract, putting more stability around the cash flows is critical what we do, and at the same time investing in areas where you have an oligopoly position, so that where there's large barriers to entry, there you can get comfortable that maybe you don't have a contract, but you have pricing power. And maybe you don't have a contract, but you also have the ability to pass through cost increases. So really looking for opportunities to put the broad brushstrokes around an asset and make it look like infrastructure, albeit it may be a little off the fairway, and you may have to tap other infrastructure players that aren't as comfortable with some of those risks.
Yeah, I mean, I definitely agree. It's difficult to make square peg round hole in terms of certain things that maybe are clearly more challenging. In terms of stuff that is probably on the fringe, maybe using an example, right? So WTIVs within the wind space, right? I think that's an example of a business that at certain parts in the cycle historically has very much been more spot-like in nature, right, or shorter-term charters in nature. when you look at the dynamics of supply and demand today, that's shifting in a way where there's probably more contract cover, right? So is it conceivable that playing in a certain time in the cycle and what that's doing to a willingness for a customer to sign up for a longer term contract, maybe that's a catalyst, or maybe there's certain funds that are a little more forward leaning than others around their definition, but it's also a little bit when you see it.
Great. I want to shift gears a little bit just to talk about the changing landscape today, and maybe I'll start with Loli, but I'll ask each of you in a slightly different perspective. But as we think about the environment today, credit market has clearly been in a state of evolution the last 12 to 18 months, with the theme often referenced of higher for longer. What impact is this having on the behavior of infrastructure investors globally?
Yeah, I mean, I think the three other panelists are probably in a better position to answer that than me, but I certainly have a view, which is, the infrastructure funds have become, I think, just more disciplined. They've obviously had to apply a higher cost of capital, just looking at where rates are, but also looking at the opportunity cost that they of making certain investments. So as I said earlier, there's more. I think there's more discipline, and I think valuations have obviously come in as well, but they're still attractive. And I think Art alluded to this in his opening comments, which is, I think the public markets are still mispricing a lot of assets, and as long as the public markets, want to take a short-term view on assets, on cash flows, on business models, I think infrastructure funds are going to continue to, I think, find a lot of opportunity out there, and that comes at the cost of public investors. But I don't know, I think hopefully there's a pendulum there, and at some point public investors come back and see that there's actually a really great total return story here that they're missing.
And Art, maybe to take that to you as someone who thinks about the world both as an operator and an investor, how is the shifting environment impacting your approach at Energos?
Well, firstly, to talk about the interest rate environment and the overall cost of capital. Now, that is a little bit of a challenge. We have situations in all types of shipping where you can find the contracts, which would generally be very favorable for infrastructure investing, but we know that the asset prices now in almost every category are quite high. So there is a challenge to think about what does that mean for your long-term investment. And I can probably repeat a number of conversations that some of my panelists here would have also had, where you like the contract, you like the asset, you like the space, but you're concerned that you're paying the highest ever price back to 2006 and 2007 levels. What does that mean? And you even say things like, yes, but we have the contract, so we're just going to leap over this, high point of the values and stuff. But that's a challenge. That makes some of the longer term and new investment decisions a little bit harder. But generally for Energos infrastructure, we're a little bit removed from that because we're in the LNG space. We do own LNG carriers, but what our primary business is in the regasification. So all of our LNG carriers also have regasification equipment that they're essentially stationary. They don't move from place to place. They stay in one place, and they receive LNG cargoes, and then they regasify, because LNG is a growth commodity right now. We see it in primary economies and in lower economic economies. Huge growth area right now for LNG. But to use it for an energy grid, for power grid, it has to be regasified, and import countries have to determine whether they want to do that with land-based infrastructure and put out the asset and the capital to build that asset. And in some cases, that's not practical, so they choose a more flexible and kind of plug-and-play solution like one of our FSRUs. So that's a big part of our growth strategy, to feed the growth of LNG throughout the world and use our FSRU strategy as that conduit.
And turning back to Daniel and to Denny, how's the shifting backdrop impacting your focus areas, whether it relates to the sectors you're looking at and or structures?
Happy to go. Yeah, sure. I would say that maybe I don't know if this is where we're going or not, but my take on that is our cost of capital has been reasonably consistent through what you've seen in interest rates that's happened over the last 2-3 years, right? How has that expressed itself? It's expressed itself in that we really struggled to put dollars out the door when rates were really low, and we didn't really get any new investments off for north of 18 months. In the last 12 months, we've done 6 new deals globally, right? And so I'd say during periods of relative capital abundance or scarcity, and or how the market might think about things like risk-free rate or where what it takes to clear our cost of capital, we've found times when there's more opportunities and times when there's less opportunities. That could be that we're buying a business. It could be, I think in today's market, thinking about businesses that need new primary capital for growth. That's a great place for us to spend time, right? As somebody who has a lot of dry powder. So that might be where I'd probably take it a little bit, is not specific sectors and maybe more kind of where we see opportunities and that kind of ebb and flow.
Yeah, I'll just add to that as well. So as buy and hold investors, similar to Daniel, we look for long-term tailwinds and areas where we see the puck going. And right now, if you think about some of the largest investable themes globally, one of those is energy security post-Ukraine, really driving LNG investing globally, decarbonization, everyone's talking about it across the entire value chain, across maritime sector. All that's creating a tremendous amount of opportunity for new capital. Similarly, given that we are closed-end funds and buy-hold investors, we're not subject to the same dynamics as the public markets, which come and go. So for us, the last couple of years has been a tremendous opportunity, given that, we like the asset, we're prepared to hold it, and we're not, necessarily mark to market. So for us, this is a great time to deploy increasing amounts of capital, given we're not going to trade in and out.
Great. We have a few minutes left. I'd like to ask the last question to all 4 of you. Maybe we can just start with Art and go down the line. But when you think about the future, what's next with infrastructure investing in the maritime industry?
For me, it's been great to watch the development from the port all the way through the entire logistics chain of infrastructure investing. And it's really, I think, it's opened up the world to shipping. It's shown the critical nature of shipping, and it started with COVID probably. All of a sudden at cocktail parties, people were talking about container ships backed up and they couldn't get their stuff. That's good in general. It wasn't good at the time to have those conversations, but it was increasing the visibility of shipping and the importance. Now we see with the global political situation, many cutoff points and the supply of energy and various types of energy and commodities around the world. How do they get there? Energy security being very, very important. What these themes are developing in is long-term contracts. Like countries, of course, LNG business and my FSRU company, that's more oriented towards governments. They're thinking long-term. They're solving something not for a short-term investment horizon, but for a long-term primary asset, something that's critical in nature for their country. And therefore, you can get new contracts there, long-term contracts, which is great for infrastructure investing.
2 themes clearly that we think is going to drive a lot of volume is supply chain reconfiguration. That's nearshoring, reshoring, friendshoring, whatever you want to call it. That's driving a lot of both land-based and maritime investment. And then, decarbonization, we're all kind of talking about it. But that's, we know where that's driving investment today. But, I think what's, fascinating for me is, a lot of the unknowns in terms of where is fuel going? What's going to be the predominant fuel for maritime transport going forward? And based upon that, we're going to see a significant amount of investment going forward.
Yeah, I just think, Brian, it's going to continue to be an evolution here. Private ship owners some are willing to take more risk than others, but have obviously been successful in investing in assets for decades and longer. And so I think there are there are more asset classes out there that as infrastructure investors can get their heads around residual risk, I think there's going to be more investment.
Yeah, I mean, the way I might take it is that the way that we invest could either be making a prediction about what is likely to change and or making a bet on what is going to show resistance to change, right? So on the making a bet for change side, right, it's things like shifting nature of supply chains, or it's a change in fuel type across electric generation or propulsion or what have you. I would also just call out that, there are definitely examples where when you find something that you think has a really high barrier to change, but that hasn't necessarily been characterized or defined as such, that can be a really interesting opportunity too. So that's maybe how I'd approach it.
Great. Well, with less than a minute left, any questions from the audience before we wrap up? Perfect. Then thank you all for the time, and thanks to Matt and Mike as well.